I don't think people understand the true power of trading strategies. In the world of finance, knowledge is power. Successful trading isn't about luck, it's about strategy. Trading strategies are your roadmap in the market. They provide structure and discipline, guiding you toward your financial goals. Whether you're a seasoned investor or just starting, a well-defined strategy is essential for long-term success. Imagine venturing into uncharted territory without a map. Trading without a strategy can feel the same way, daunting and risky. This essay will delve into some of the most effective trading strategies used by professionals worldwide. Understanding these tools will empower you to make smarter trading decisions. The Fibonacci sequence, a series of numbers where each number is the sum of the two preceding ones, has profound implications in trading. Traders use Fibonacci ratios to identify potential support and resistance levels in asset prices. These ratios, including 23.6%, 38.2%, 50%, 61.8%, and 100%, represent key levels where price retracements or reversals are likely to occur. By understanding how these ratios work, traders can anticipate potential price movements and make more informed trading decisions. Think of Fibonacci ratios as guideposts in the market. Just as a hiker uses trail markers to navigate, traders use these ratios to understand price action and identify potential trading opportunities. In the next section, we'll delve deeper into Fibonacci retracements and explore how traders use them to pinpoint potential entry and exit points in their trades. Understanding this powerful tool can significantly enhance your trading strategy. Fibonacci retracements are a popular tool among traders to identify potential support and resistance levels in asset prices. These levels are determined by drawing horizontal lines on a price chart at specific Fibonacci ratios. To use Fibonacci retracements, traders first identify a significant price swing high and swing low on a chart. Then they draw Fibonacci retracement lines at the key levels of 23.6%, 38.2%, 50%, 61.8%, and 100%. These levels act as potential support and resistance zones, where the price might reverse or stall. For example, if a stock price rises from $10 to $20, then retraces to $15, a 50% retracement. Traders might look for buying opportunities around that level. However, it's important to note that Fibonacci retracements are not foolproof. They should be used in conjunction with other technical indicators and analysis techniques to confirm potential trading signals. Breakout trading focuses on capitalizing on significant price movements that occur when an asset breaks out of an established trading range. These breakouts often happen with increased volume and volatility, signaling a potential shift in market sentiment. Breakout trading aims to capture the momentum of a price movement as it breaks through a resistance level for buy breakouts or a support level for sell breakouts. To identify potential breakouts, traders look for chart patterns such as triangles, rectangles, and head and shoulders patterns. These patterns indicate periods of consolidation where the price is range-bound. When the price finally breaks out of this range, it often signals a decisive move in that direction. Breakout trading can be highly profitable, but it also carries risks. Therefore, it's crucial to confirm breakouts using other indicators, such as volume, momentum, and trend lines, before entering a trade. Section 5. Recognizing chart patterns for breakout trades. Chart patterns are like footprints in the sand, providing clues about potential future price movements. For breakout traders, recognizing these patterns is crucial for identifying potential trading opportunities. Two common chart patterns used in breakout trading are triangles and rectangles. Triangles, as the name suggests, are chart patterns formed by converging trend lines. These patterns indicate a period of consolidation where the price is squeezing between support and resistance lines. The breakout from a triangle, either upward or downward, often signals the direction of the next significant price move. Rectangles, on the other hand, are chart patterns characterized by horizontal support and resistance lines. When the price breaks out of this rectangle, it usually signals a resumption of the previous trend. Remember to confirm breakouts using other indicators to avoid falling for false signals, which can lead to losses. Section 6. Unveiling the secrets of reversal patterns. While breakout trading focuses on capturing momentum, reversal patterns help traders identify potential trend changes. These patterns suggest that the current trend is weakening and a reversal in the opposite direction is likely. Recognizing these patterns is crucial for exiting losing trades early and entering new trades in the direction of the new trend. One common reversal pattern is the head and shoulders pattern. This pattern resembles its namesake, with a peak, the head, flanked by two lower peaks, the shoulders. A break below the neckline often signals a trend reversal to the downside. Another popular reversal pattern is the double top or bottom. These patterns occur when the price reaches a certain level twice, but fails to break through, suggesting a potential reversal. Using a combination of tools and techniques will enhance your decision-making process and improve your trading accuracy. Section 7. Mastering the art of candlestick patterns. Candlestick patterns, originating from Japanese rice traders centuries ago, provide a visual representation of price movements over a specific time frame. Each candlestick tells a story, revealing the battle between buyers and sellers during that period. Learning to read these patterns can give you an edge in understanding market sentiment and predicting potential price moves. A basic candlestick consists of a body and two wicks, or shadows. The body represents the price range between the open and close, while the wicks indicate the high and low prices during that period. There are numerous candlestick patterns, each with its own unique implications. For example, a doji candlestick suggests indecision in the market. A hammer candlestick indicates a potential bullish reversal, especially after a downtrend. By understanding the language of candlesticks, you can gain valuable insights into market psychology and make more informed trading decisions. Section 8. Technical indicators, your guiding stars in trading. Technical indicators are mathematical calculations based on historical price and volume data. They act as your co-pilots in the trading world, providing valuable insights into market trends, momentum, and potential overbought or oversold conditions. By understanding and interpreting these indicators, you can make more informed trading decisions. Some popular categories of technical indicators include trend indicators, momentum oscillators, and volatility indicators. Trend indicators help identify the direction and strength of the prevailing trend. Moving averages, one of the most common trend indicators, smooth out price fluctuations to reveal the underlying trend. Momentum oscillators measure the speed and magnitude of price changes, signaling potential trend reversals. Volatility indicators measure the degree of price fluctuations, indicating potential for large price swings or a calmer market. By combining different tools, you can increase the accuracy of your trading decisions and improve your chances of success in the market. Section 9. Moving averages, smoothing out the price action. Moving averages are like noise-canceling headphones for traders. They filter out the daily price fluctuations, helping you focus on the bigger picture, the underlying trend. By smoothing out the price data, moving averages provide a clearer picture of the market's direction and potential support and resistance levels. There are different types of moving averages, but the two most common are the simple moving average, or SMA, and the exponential moving average, or EMA. The SMA is calculated by adding up the closing prices of an asset over a specific period and dividing the sum by the number of periods. The EMA gives more weight to recent prices, making it more responsive to current price action. Traders use moving averages to identify crossovers and potential support and resistance levels. In an uptrend, a rising moving average can act as a support level, while in a downtrend, a falling moving average can act as a resistance level. Section 10. Momentum oscillators. Measuring the power of trends. Momentum oscillators are like speedometers for traders, measuring the velocity and strength of price movements. They help identify overbought and oversold conditions, signaling potential trend reversals. One popular momentum oscillator is the Relative Strength Index, or RSI. The RSI oscillates between 0 and 100, with readings above 70 typically considered overbought, and readings below 30 considered oversold. Another widely used momentum oscillator is the Moving Average Convergence Divergence, or MACD. The MACD consists of two lines, the MACD line and the signal line. Crossovers of these two lines can generate buy or sell signals. By combining different tools, you can increase the accuracy of your trading decisions and improve your chances of success in the market. Section 11. Conclusion. Your path to smarter trading. In the ever-changing world of financial markets, knowledge is your most valuable asset. By understanding and applying the trading strategies and tools discussed in this essay, you can navigate the complexities of the market with greater confidence and increase your chances of success. Remember that trading is a journey, not a destination. It requires continuous learning, adaptation, and discipline. Always approach trading with a risk management mindset. Never risk more than you can afford to lose, and always use stop-loss orders to protect your capital. By embracing a disciplined and strategic approach to trading, you can turn the challenges of the market into opportunities for growth and success.